Hello, I'm Charlie Moran. I'm an analyst here at Value Line. I'm joined today by two other senior analysts, Nate Ekman and Alan House. Today we're going to provide an update on the economy and stock market. We will then recommend one stock to buy right now and finally answer any questions you may have. Please note that this presentation will be available on our website, valueline.com, and on our YouTube channel within the next 48 hours. All previous webinars are also posted. Before I jump into the heart of the presentation, for those joining us for the first time, I want to provide a brief overview of who we are at Value Line. We are a New York headquartered corporation that has been providing investment research for more than 90 years. Our flagship product is the Value Line Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on equities that trade on the New York Stock Exchange, the NASDAQ, and the Toronto Stock Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Value Line's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. One thing I want to stress is that our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Value Line has no investment banking business with any company, including all the equities under our coverage. Value Line does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. If you have any questions about the products or services we offer or our different tiers of subscriptions, that information can be found at valueline.com, or you can call 1-800-VALUE-LINE. Now let's discuss the economy and the stock market. This content was prepared by Value Line's economic staff. The Federal Reserve Bank appeared to confirm last week that the steepest rate hike cycle in decades is likely over. As expected, the Federal Open Market Committee held the federal funds rate in the range of 5.25 to 5.5%. It was the third consecutive pause for the central bank, and Chair Powell indicated that the bank will be cutting rates later on in 2024. The key reason, the Fed said that inflation had eased, lowering its 2023 core personal consumption expenditures, PCE, forecast by 0.5 point to 3.2%. A soft landing is looking more likely as the nation created an estimated 199,000 jobs in November. That figure exceeded the consensus forecast and was at a level indicative of a still tight labor market. It was accompanied by a drop in the unemployment rate from 3.9 to 3.7%. Average hourly wages, though up a stronger than expected 0.4% on a month-to-month basis, did tick lower over the last year, suggesting some moderation in salaries. The increase in the labor force participation rate also had to please the Fed, as more workers looking for a job should put downward pressure on wage growth. The consumer sector has proven very resilient, and that has fueled economic expansion. According to Adobe Analytics, consumers spent $38 billion, up 7.8% year over year in the period running from Thanksgiving to Cyber Monday. Shoppers are emboldened by the increase in wages as salaries are now rising at a faster pace than prices. Equities took off after the Fed announcement, and the bull has kept on running through our press time, with the resilient small-cap sector taking the lead. Not coincidentally, bonds saw longer-term yields back off, with the benchmark 10-year U.S. Treasury note touching below the 4% level. In conclusion, Wall Street has liked the Federal Reserve's effort to promote price stability, has not yet come at the expense of a healthy labor market. Combined with the reduced bond yields and the Fed's hints that it is done for this cycle, we may be looking had an engraved invitation for a continuation of the recent Santa Claus rally. On that note, Value Line provides a great deal of information and analysis to help our subscribers. We know that most of our users depend on our weekly stock reports, time-tested ranking systems, and other valuable services. In addition, Value Line offers a great deal of daily content that can help you avoid the pitfalls and profit during this volatile time in the stock market. Every business day, senior members of Value Line's research department review the most actively traded stocks, company press releases, news stories, trade periodicals, and other sources for data and information that may change our view and investment recommendations for specific stocks. When something noteworthy crosses our desk, we immediately publish a supplementary report that outlines the new information and, importantly, what it means for the stock and shareholders. This content is posted throughout the day on our website. Again, that's valueline.com. I will now show you how to access those reports. Once signed in on the website, head to the dashboard where I am already located, and this is the main landing page for subscribers. Under the quick links, click on Supplementary Reports. As you can see, the research department has been busy publishing our updated thoughts on the stocks that we track. We strongly suggest that subscribers visit this page often. Some individual companies incurred a lot of debt or sold stock to improve liquidity over the last few years, especially those dealing with sharply reduced demand for their offerings and supply chain problems, among many other issues. Due to the changing structure of company balance sheets, Value Line has been reviewing and altering our proprietary financial strength grades for the stocks in our coverage universe. These changes are posted each week in our Selection and Opinion newsletter. For those of you that don't know, financial strength, along with price stability, another proprietary Value Line measure, are the two metrics that are used to calculate a stock safety rank, a key measure of risk. When considering a new stock to invest in, we strongly suggest that you utilize financial strength and safety in your decision-making process. For more information in regard to our proprietary ranks and ratings, Value Line provides a user guide that can be accessed via the investment education section of our website. Lastly, this is a good time to mention that the case for individual stocks is quite strong over broad index funds. Now let's move on to the one stock to buy right now. For this, let's go to the screener. Value Line subscribers have access to 15 preset screens and 50 fields for screening stocks. I should also mention that another 100 or so fields are available, require a higher level of subscription. If that interests you, please call 1-800-VALUE-LINE. Okay, going to the screening criteria. As noted in our economic analysis, although there are some positive indications looking ahead to 2024, much also remains uncertain. As such, we'll be looking for stocks with a better than average risk profile and strong return potential over the long term. We'll start the screening process by looking at the safety rank in the ratings and ranks section. And let's see here. There we go. We're looking for a safety rank of 3 or better. There are many risk measures to consider, but today we're going to start by applying our time-tested safety ranks. Safety measures the total risk of a stock and is arranged on an easy-to-understand scale from 1 to 5, with 1 being the most conservative issues. I want to highlight the fact that stocks ranked favorably for safety have in the past held up far better than the broader market during corrections and downturns. They also meaningfully participate in up markets. For more information, I encourage you to peruse our ranking system guide, which is available free of charge from within the investment education section of our website. We're going to focus again on stocks with a safety rank of 3 or better, and by applying that first criteria, we've trimmed away our potential candidates to 2,066, down from 5,700. Next, we're going to filter for timeliness. And one of our tried and true measures, timeliness is a proprietary value line metric that evaluates a stock's projected price performance in the coming 6 to 12 months. Like safety, it's a straightforward scale from 1 to 5, with 1 being the highest. Today, we want a stock that will outpace the overall market over the short term, so we're looking at stocks ranked 2 or better. And by applying that screen, we've trimmed the list to 297 candidates. And for the third screen, we're going to look at the 18-month target price range, and we're going to seek a midpoint of 25% or better. While timeliness rank measures a stock's likely performance over the next year, we also want to extend our view and look at likely performance over the next 18 months. We are using a filter of 25% or better. To put things in perspective, the median 18-month appreciation potential right now is currently 10%. And by applying this filter, we have reduced our opportunity set to 45 stocks. And let's go to the fourth filter, projected 5-year earnings per share growth of at least 10%. Changing gears and focus on stocks with 3 to 5 year earnings per share growth of 10% or more. By applying this criteria, we've cut the list down to 19 candidates. And for the fifth filter, next we will focus on companies with 5-year sales growth of at least 10%. While the bottom line is an important factor to consider, sometimes earnings gains are driven by cost cutting, which can only go so far in some instances. So hence we're going to focus on companies that can grow their top lines. After running this screen, we are down to 13 candidates. And finally, we want to look at a stock's price to earnings multiple relative to other stocks under our coverage. We're going to focus on equities with a relative PE of 1 or less, which implies relative value. And after applying this screen, our list is now down to 5 possibilities. You can make a strong argument for any of the remaining candidates, and investors interested in adding new positions should consider all of them. However, only one can be today's one stock to buy right now, and after consulting with a number of our senior analysts, we prefer and recommend Arch Capital Group, ticker symbol ACGL. Before I click on Arch, please note that screens can be saved and revisited by utilizing the Create Saved Screen button at the top of the screen. Okay, let's look at the last full page report, if Alan can bring that up. Okay. Great. Arch Capital provides insurance and reinsurance products across the globe for a myriad of industries. As you can see in the statistical array, which is the area in the center of this report that includes the financial data, net premiums earned, and earnings per share are likely to be up again this year as company-specific fundamentals remain strong despite some macroeconomic headwinds. In fact, the stock has handily outperformed the value line arithmetic index over the past year, and strong earnings prospects give us optimism in the year ahead. The company is well positioned in the insurance industry and will likely continue to garner market share in the years ahead. Its well-diversified status also gives it a leg up on the competition. While industry-wide catastrophes have been above average over the past year or so, the company's managed to weather the storm quite well, as its combined ratio is likely to be very profitable in 2023. We attribute this to the company's high-quality insurance book of business and its diversified status. Profits have also received a shot in the arm from increased bond reinvestment rates over the past couple of years. The company's finances are solid with a financial strength rating of B++ and only a moderate amount of debt. The stock's strong 18-month appreciation potential is also an attractive feature for investors with an intermediate-term investment horizon. We also look for the company's customer base to expand moving forward, while policies ought to be renewed at higher pricing levels. Overall, we think that Arch Capital is likely to hold up well in 2024 with above-average price appreciation potential over the long term. It is today's one stock to buy right now. We will now tackle your questions. Please note that I typically can't answer complex questions about specific stocks on the spot. For this, I recommend a review of our latest reports. The first few questions were submitted prior to this presentation, and now I will hand it off to Nate and Alan.
Thank you, Charlie.
Okay.
I saw one question come up that I found interesting. Someone was asking about, the relative value and the relative valuation and why we use that parameter. And I think particularly in this market, the way the market has been over the last few months, I think it's important to look at a stock's valuation relative to other equities. And as you can see, with this stock, the relative value is just about 60% of the overall market is 0.61. That generally implies that the stock will be less susceptible to a downturn, or if a downturn does occur. So I just wanted to point that out, that we not only did we look at the growth metrics, but we also looked at the value. We wanted to look at some valuation metrics, which included safety and the valuation. We also wanted to kind of rate the risk of the stock. So we thought, on balance, this was a good selection based not only on capital appreciation prospects, but also based on its risk profile. Thanks.
Mm-hmm. Let's see, other questions. We've got a question, where will the recorded webinar be available? As was mentioned, that's going to be on our YouTube channel later. So keep an eye out for that.
I also saw a question regarding the combined ratio. Someone was asking about the combined ratio. And the combined ratio for an insurance company is equal to the loss ratio plus the expense ratio. As you can see in the array here, we have the loss ratio and the expense ratio. Those two figures combined are the combined ratio, and 100 minus the combined ratio is the underwriting margin. And just to put things in perspective, Arch Capital's underwriting margin has been well above the industry average. It's been, as you can see, it was 18.4 last year. It's estimated to be 19.3 this year, and that's significantly above the industry average. In fact, catastrophes have been higher than normal thus far this year. There's been a lot of weather-related occurrences and, wind-related and natural disasters and things like that. And, thus far, Arch Capital has weathered the storm very well. So it's ahead of the game as far as that goes, as far as the underwriting margin goes. Thank you.
I'm seeing a question about what exactly the timeliness rank represents. So the timeliness rank is relative price performance over the next 6 to 12 months. It's important to understand that it's a relative measure. So that's, on a scale of, 1 to 5, with 1 being the best and 5 being the worst, how well do we expect the stock to perform in terms of price as compared to every other stock that we cover. So that's what timeliness is measuring.
I also see another question regarding the effect on interest rates on insurers. And insurers have actually benefited from the rising interest rate environment to an extent, as it's helped bond yields. A lot of, insurers, due to their conservative nature, generally invest predominantly in fixed income securities, and yields have been very high of late because of the higher interest rates. So when those bonds are when when the cash flow is reinvested, it's reinvested at higher rates, which is good for investment income per share. Now, of course, the Fed said that they're most likely, done with their tightening cycle, may in fact start to reduce rates next year. So that's something to keep an eye on in the insurance industry. Albeit that yields are still at exceptionally high levels compared to historical levels, but that's a figure that may start to creep down a little bit as interest rates, perhaps trend lower next year. Thanks.
Mm-hmm. I see a question. How many quarters are forecasted in the PE ratio figure? So for that PE ratio figure at the top of the page, that's going to be the results from the most recent quarter and then the next 3 quarters. So it's a full year of results, 1 actual figure, 3 estimates.
I also see a question about the 18-month target price range, and we use that factor in this scenario along with the long-term assumptions and the timeliness rank, because that's more of an intermediate factor. We think it's something that's very important to look at as well. Value Line's known for its time-tested timeliness rank, and we've also done 3 to 5 year projections for a long time. But several years ago, we enacted the 18-month target price range, which I think paints a good picture of how we think the stock will perform over the next year and a half or so. So, as we noted in our presentation, that Arch Capital's 18-month target price range or appreciation potential is well above average. The average is only about 10% now, so it's considerably above average in that regard. And it's also, based on our longer-term projections too, are above average. So it's got some good attributes for investors of all varieties. Thank you.
Okay, I think that about wraps it up. Let's get back to the moderator, Peter.
Thank you, everyone. Thank you to our speakers, and thank you to our attendees for joining today's session. This does conclude today's session, so feel free to disconnect your lines and have a great rest of the day.